Welcome to Geojit Spotlight. The market's recent volatility has left the investors on edge. Join us as we speak with Dr.V.K Vijayakumar, Chief Investment Strategist at Geojit, to get answers to your burning questions. We will discuss the near-term market outlook, the earnings recovery prospects, and the potential implications of a Trump presidency. Welcome, sir.
Thank you, Abhilash.
Sir, market corrected about 11% from the peak in September. During the last 2 days, there has been a recovery of more than 900 points in Nifty. Can the rally sustain, and what are the likely near-term trends?
Yes, the market corrected around 11% from the peak levels in September. Well, a 10% correction, double-digit correction is normal. You look at the history of Indian stock markets, in almost every year, with the exception of a few years, 10% corrections have happened. That is normal, par for the course. But what we have to understand is why this correction happened. What are the factors that led to this correction in the market? I have explained one point repeatedly in our programs, and that is Indian valuations have been higher than the historical averages. Even now, the valuations are higher than historical averages. You take the last 10, 12 years long-term average PE ratio in India, it is around 18 PE multiple, long-term average. But if you take the last 4 year or 5 year, it will be much higher. But long-term is around 10 to 12 years. So 18 is the long-term average PE multiple. Now, even after this correction, presently with Nifty around 24,000, the PE multiple is around 20. Now Nifty is trading at around 20 times FY 26 earnings, 1 year forward earnings. So when the valuations are elevated, some triggers can cause the correction. And 3 triggers happened to cause this correction. One was the massive FII selling. For 38 consecutive trading days, FIIs were sellers in the market, and they sold equity worth 1,55,700 crores of rupees approximately. In previous years also, selling has happened, big selling has happened. For example, in 2022, FIIs were big sellers. But for the entire calendar year 2022, they sold stocks worth 1,46,000 crores of rupees. Now in 38 trading days, they sold more than that. So sustained FII selling pulled the market down. Second factor that led to this acceleration in FII selling and a deeper correction in the market was the poor Q2 results. Second quarter results came worse than expected, and the indications are that this weakness will continue. So the consensus estimates among brokerages now is that FY25 corporate earnings, Nifty earnings, growth will be around 10%. And next year also, that is FY26, earnings growth estimates now are around 14%. So that means these 2 years, Nifty earnings will be growing at an average of 12% for 2 years. Whereas the last 3-year average was more than 20%. So this is a clear earnings slowdown, and this is impacting sentiments. And this has also prompted FIIs to sell. Thirdly, we saw this Trump trade, which led to selling all over the world, not just in India. Funds sold in emerging markets like China, like India, developed markets like Japan and Europe, and took the money and invested the money in US stocks, because Trump's policies will benefit the US corporates, and therefore a lot of money flowed there. Now we have to understand the size of the US corporate sector to really comprehend why such big money is flowing into US now. I'll give you an example. Now there are 7 stocks, group of 7 stocks called the Magnificent 7 stocks. These are all the modern tech stocks. These 7 stocks are Amazon, Apple, Alphabet. Alphabet is Google's holding company. Then Microsoft, Meta, former Facebook. Then Nvidia and Tesla. These magnificent seven stocks have a market cap of $16.8 trillion. $16.8 trillion. Seven stocks, right? You take, for a comparison, if you take two stocks out of this, let us say Apple and Nvidia, the market cap will be close to $7 trillion now, or let's say $6.8 trillion. So these two stocks have a market cap which is far higher than the entire market capitalization of the Indian market. Our market capitalization is now around $5.3 trillion. So this is the size. The size is very important, right? So unless you have this sense of proportion to comprehend the size, it will be difficult for you to understand why money is moving out, big money is moving out. So this flight of money to US, to the large stocks in US, that also pushed the dollar value up. Dollar index is above 107. Even now, dollar index is above 107. So when dollar is appreciating, that is another negative for the FIIs to come to emerging markets. So all these three factors combined together to bring the market down by around 11%. But I would say from the economic perspective, from the market perspective, from the fundamental perspective, the concern is the earnings slowdown. Because if India is to have only 10% earnings growth this year, this financial year FY25, and only 14% next year, that will be around a 12% approximately average growth for 2 years. So naturally, FIIs can ask, why should we give a high valuation to a market which is delivering only 12% earnings growth? So I'm more concerned about that. But there is a possibility that there can be an earnings recovery in India. We have to wait for that.
So you said that the earnings slowdown is the serious concern. And when do you see an earnings recovery?
Well, Q2 results, as I told you, were worse than expected. A slight recovery may come, we are not very sure about that, in Q3. But in Q4, big recovery is possible because this earnings slowdown is primarily due to the growth slowdown also. GDP growth also has slowed down. Now that growth slowdown is mainly because of decline in government spending. Government spending suddenly declined, and therefore our fiscal deficit also is much lower than what is projected in the budget for the corresponding period. And the reason for this decline in government expenditure is, one was the elections. During elections, there are restrictions on government expenditure. And also during August this year, due to unseasonal prolonged rains, a lot of project expenditure were impacted. So one major reason for the growth slowdown and earnings slowdown was the decline in expenditure. This is likely to change. Already the government has started increasing public expenditure. That is evident from the cash balances with the RBI. It has come down drastically. So that means the government is increasing the expenditure. So the result of that will be visible in Q4 results, partly in Q3 results also. Perhaps we might get a clue about this positive trends in the leading indicators. There are leading indicators like freight, like power consumption in the economy, like GST collections. These are leading indicators. And these leading indicators, automobile sales also, or these leading indicators can give signs of revival of growth in the economy and corporate earnings. So when these the data become evident, then the market will positively respond to that. My own feeling is that by Q4 of this financial year, and earnings rebound is very much possible.
There is a general opinion that Trump 2.0 can have a big consequences. What are the likely consequences, particularly from the Indian perspective?
Well, Trump presidency, Trump 2.0, is likely to have profound consequences. There is a consensus among experts, foreign policy experts, economists, market experts, that his presidency, the second term, will have big consequences. The reason he is not a conventional politician. He will do what others will not do, and also he has the advantage of majority Republican control in the Senate and the House of Representatives. Also, this was something which Biden or President Obama did not have. So this will enable him to take some strong decisions. But then, even though he is a very likely to be a very strong president who will be taking very bold decisions, there are certain factors which will restrain even President Trump, because I'll explain this. He said we will impose up to 60% tariffs on Chinese imports and 10 to 20% tariffs on other countries with which US has trade surplus. Now, it is not possible practically to impose 60% a duty on, let us say, Chinese imports, because, for instance, if a particular category of Chinese goods now have 10% duty, and if this import duty is raised to 30%, that means the landed cost of these goods in dollar terms will increase by 20%. So that will push up prices by 20%. That means inflation in the US will go up. And if inflation in US goes up, the Fed's, American Central Bank Fed's monetary policy will have to be completely changed. The Fed has succeeded through last 2 years of very sensible monetary policy to bring down inflation to near long-term average levels. The Fed did actually a wonderful job, and the Fed has almost succeeded in achieving what economists call a soft landing for the US economy. Soft landing is containing inflation without pushing the economy to recession. But then, if this 60%, not forget about 60%, even 30% duty on products on which there is only 10% duty now is imposed, that will push up inflation rate, and the Fed will have to think of raising interest rates. So even though he is going to be a very powerful president, there are limitations, economic limitations, which will be restraining President Trump. We have to understand that. But then, of course, he will be imposing import tariffs, particularly on countries like Mexico, Canada, Vietnam, etc. And India also will not be spared, because he formerly called India as a tariff king. So he is not very sympathetic to India's tariffs, even though he has got a very good political equation with the Prime Minister Modi. So India also will not be spared. But then some political treatment, favorable treatment may be there, and also the policy that is being followed by US corporates, the China plus one policy, that will also benefit India. But then what will be the policy decisions which President Trump will be taking, how it will evolve, that remains to be seen.
And what should be the investment strategy?
Well, when we think of investment strategy in the present context, we should always keep in mind the growth slowdown that India is experiencing now. It may be very short term, but then presently we have that slight growth slowdown, which is reflecting in the corporate earnings slowdown also. But a very important point that we have to understand is that this growth slowdown is not widespread. It is not comprehensive to the entire economy. It is happening in some sectors. For example, sectors like cement, there is a growth slowdown. In segments like steel and metals generally, there is growth slowdown. In FMCG, fast-moving consumer goods, there is a moderate demand, very poor demand, declining demand from even urban areas. So that is a segment where investors should not be looking for in the present context. But in contrast to these sectors which are slowing down and facing headwinds of earnings growth, we have segments which are doing very well. For example, banking is doing reasonably well with a decent credit growth, and the asset quality also is improving. IT is one segment which is likely to have reasonable growth, not fantastic growth, but reasonable growth, because Trump's corporate tax cuts in the US will be benefiting Indian IT companies, because when the profits of companies go up, they will be spending more money on technology. This will be beneficial for Indian companies, not only the large companies like TCS, Infosys, HCL Tech, but also mid-cap companies like Persistent Systems, Coforge, and companies in that segment. Then there is digital space. Digital space, the business is growing, market share is growing for companies like Zomato, Paytm, and the like. Their market share is growing. There is no growth slowdown at all. Growth is very impressive. Then there is the luxury segment in SUVs, in automobiles, and also in hotels, for example. The five-star hotels are doing well. That is already reflected in for example, look at the share price of Indian hotels. The company is doing very well, and that is already reflected in stock prices. Then there are beyond the segments. And again, when we talk about segments, we can think about pharmaceuticals, which have good growth prospects. And also in automobiles, not automobiles generally, but the segments, certain segments in which certain companies are experiencing good demand. For example, M&M, Eicher Motors, then automobile component manufacturers. These are segments which are doing very well. So the focus should be on that. In the last audio message that I gave, I think last week, we had suggested the two stocks. One was Divi's Lab from pharmaceuticals, and the Trend, the Tata company Trend from the retail consumer space. They have done well. Last few days also they have done well. But then even in these stocks, there is no valuation comfort now. Valuations are rich. But then if you are a long-term investor with a 3-year time horizon, these stocks can be bought even now, because they have a very long runway of growth. So when we talk about investment strategy now, I will summarize by saying these are the segments which we should be focusing on. Then generally our message to investors now is safety is in large caps, not in mid and small caps, where valuations continue to be excessive. Valuations are even now excessive and continuing to be excessive because there is no foreign institutional selling in those segments. FIIs do not own them in a sizable scale. But then we again know from experience that in the long run, 5-year, 10-year perspective, mid and small caps can outperform. Therefore, investors should continue to invest in mid and small caps. But rather than investing directly in this, schemes, it would be better to invest through systematic investment plans in the mid and small caps. And only also investors who want to put in bulk investment, they can think about systematic transfer plans in mid and small caps. That should be the investment strategy in the present context.
Thank you, sir. Thank you very much.
Thank you very much.